So it's a dilemma. I mean, so we basically, bottom line is, if the government of Canada is real serious, because we have our economy here, and there's a whole other economy in Ontario, which is much more affected by manufacturing. So their obligation is going to be to try to allow manufacturers to be as competitive as possible. They're going to do what they need to do to try to prevent the dollar from rising any faster than it's going to rise, which is probably still going to keep going up. So that would mean then that in theory we will link our interest rate issues to those of the US unless we start to see some internal inflation in Canada. And that means that our interest rates could stay lower longer than anybody could imagine, but at some point they have to rise, because even if we have 1 or 2% inflation, I think that was the number that Rob was talking about, our short-term interest rates should be, on average, based historical numbers, should be around 2 to 3% above that inflation rate. So that would mean our floating rate would be 4%, maybe 5%, and a 5-year mortgage would probably be 6 or 7% in a normal environment like we're in right now. Okay, so normal as in the inflation environment that we're in now. So clearly we're suppressing interest rates, and it's suppressing mortgage rates, which is allowing housing prices to rise. So at some point, although I think it'll be longer, it might be a year before you see material moves in rates, at some point they're going to go up.
But everybody's saying sometime before the summer.
I don't know, Dave. I mean, it could be sometime before the summer, but I think percentage-wise, if the U.S. has virtually no chance of raising interest rates as soon as they were talking about. Well, the U.S. has a problem from an unemployment perspective, and we don't know the impact of the stimulus plan that they've got being reduced. I mean, at some point, the impact of stimulus, a large part of the GDP that Rob was talking about in the last quarter came from government stimulus, actually not just in the U.S., but in Canada as well. So you take away the punch bowl, and you raise interest rates at the same time, that W recession that Rob was talking about is very likely to occur. So I think governments aren't going to, they're not under any pressure here. So they don't have to raise interest rates in the States, and my guess is they won't until they really need to. And then because of that, I don't think we will. So what's your thought?
If you look in the U.S. at the federal funds futures rate, right now they're discounting a Fed funds rate of 50 basis points by the end of the year. So the futures market, the financial markets are telling you that by the end of the year, the U.S. are going to raise interest rates. The thinking is in Canada, I mean, I agree with you, Dave, I mean, what is that going to do for the dollar? Yeah, it's going to go up. But you know what? The Canadian dollar has been going up already in anticipation, I think, of the fact that the Bank of Canada is going to raise rates. And you can, balance off the impact of a higher dollar to Southern Ontario versus a housing bubble. I mean, one could look at the market and we could wonder, is it a housing bubble? Well, if you keep interest rates at practically zero for an indefinite period of time and you have 2% inflation, you're effectively paying people to borrow money. And that's what we've seen happening, especially in Vancouver. Everyone's scrambling to buy a home to take advantage of these low mortgage rates. Everyone knows rates are going up. At parity, is that a fair price for the Canadian dollar? Purchasing power parity would actually indicate that the dollar is overvalued now. And what a lot of people are saying is that, yeah, it could go to parity, it could go a bit beyond, because that's the momentum taking it up there, but then it would slip back down towards 90 cents. So, but I will say one caveat. Trying to judge foreign exchange and the currency markets over a short period of times, and even long period of times, is very, very difficult. And it's not something that when we look at investments, that we're not going to buy an investment just for the currency.